Money Radio for a really great future. We're talking real money.
If you wait long enough, you'll be fine. That is the mantra of the long-term investor in the equity markets. If you wait long enough, you should be fine, because that's the way it's been. Recently I interviewed David Booth from Dimensional. He said, 100 years, the average return's been about 10% per year. You double your money about every 7 years, although there are some bad times in there. Bad times happen. But that has been conventional wisdom. Patience eventually pays off. You just don't know how long. You have to be patient. However, apparently, we aren't right. Stock markets, if you wait long enough, don't always go up, Tom?
No, I mean, and Professor Edward McQuarrie from Santa Clara says maybe not. This from a rewrite of his study that was in the Wall Street Journal, that it's a common belief that while U.S. stocks can inflict losses, as you say, in the short term, they are sure to deliver gains if you hold them for 10 years, and if not 10, definitely in 20 years. Well,
okay, wait a minute. I hate the use of the word sure. See, I didn't even use that.
I know.
I use the word should, because sure implies absolute 100% certainty.
Yeah. And according to the professor, this perception is a misconception. Now, he goes back and looks at stock market returns, going way, way, way back. Now, normally when we talk about things, we talk about them about 100 years, because I think there's good data for 100
We
years.
go back to about 1926 because the data is so robust for that time frame. Going back farther, I was reading another study. It's hard to find the numbers.
Yeah, well, Professor McQuarrie thinks you should go back to 1792. Which is a couple years ago. And
isn't that when they were trading under the tree?
I think that they just landed in the U.S. or something. But okay, 1792. He finds these 10-year periods.
We were a country then,
okay,
sir.
Very good. He finds these 10-year periods, not much of one. He finds 10-year periods where, adjusted for inflation, you did lose money by investing in stocks. He also points out that internationally, you can find worse examples. Japanese stocks lost 64% in the 20 years ending in 2009, and Norwegian stocks lost 74% in the 30 years ending in 1978. That's a long time to get your money back.
Okay, but how many people put all their money in Norwegian stocks?
I'm trying to remember what that IKEA. Anyway, I can't remember. Really
that's Denmark.
That's Denmark. Yeah, I'd have to think what stocks are there, but it's an interest. Now, the things we do not know when we tried to find out are, does this study include dividends, which would be an important part of investing? I hope it does, because if not, it's very misleading. This really only looks specifically at these lengthy periods of time. I mentioned international stocks, but primarily at U.S. And he does admit that being diversified gives you some protection, right? Because U.S. might be up, international might be, all those things that don't go up and down together. Further, the article quotes our friend Hendrik Bessenbinder of Arizona State University, who found, it's still astounding, 52% of individual stocks had negative cumulative returns during the period 1925 to 2023. Other stocks gave modest gains, while a handful delivered spectacular gains. In other words, owning all of them, because you don't know which ones are going to be the next Apple and which one might be the next Enron.
And Bessenbinder's research says it's only a handful.
Yeah,
Problem is, if you don't pick that handful, then you're in trouble.
You're in real trouble. So it was, I got to admit, when I got, and I know, yes, Don knows I read the printed version of the Wall Street Journal.
I don't even know what that is, that sound anymore. It's not recognizable.
Comes to my rather remote residence, which is still shocks me, and is there by like 5 o'clock every morning, which I love. But when I got this and I saw this, I was surprised. I will tell you, because I do trust stocks over the long haul. I do believe in being in equity markets. You know that. I've been in them a long time, and I sort of, in a bigger picture way, trust capitalism. Now, I did a little more research, as did you. We can talk about the stuff you found, but I found a piece where Edward McQuarrie wrote about the comments and criticism he's gotten, and he wrote a piece for the CFA Institute. This is the Certified Financial Analyst. These are the people that really dive into the numbers. And he went through the misconceptions he believes from these studies, which I find fascinating. He said misconception number one.
Defending himself, huh?
Exactly. McQuarrie doubts whether stocks are a good investment over the long term. Then he says, nope. Rather, I want you to adjust your expectations for long-term wealth that you can expect from holding stocks, especially a 100% stock portfolio over your idiosyncratic personal time horizon.
Okay,
I
what
think
does
that's
that mean?
Well, what that means is you may get lucky and invest for
Are you calling me an idiosyncratic?
without a doubt, among other things. But if you buy and hold for the right 30-year period, it could look fantastic. If you bought and held for the wrong 20 or 30-year period, let's say the 1930s to the early 1940s, et cetera, there could be periods of time where you got in and you had to spend the money out in the wrong period. So I totally agree with that, and it makes sense. But what he's really trying to say is, he admits this, stocks are not guaranteed to make you money over the long term. But in fact, stocks have rewarded investors over the long term despite large fluctuations in the short term. Then he goes through several periods of time where, wow, the money, he points out that over 36 years, 1922 to 1958, investment in stocks of $10,000 turned into $340,000, despite what that didn't have that thing in 1929. He goes through some other examples, but he said there's no guarantee of any reward. We try to point that out. The only thing we can base
there is no
history.
Guarantee.
That's it. That's all we know.
No, but wait, there's no guarantee that any of us will be here 30 minutes from now.
Good point.
So you don't get guarantees, and we've got to quit asking for guarantees. But the fact is that equities in aggregate, and that's the problem, we can't look at them in microscopic detail, and that's what you're looking at in large part when you look back at the 1800s, the early 1800s. It was a different market back then. It's not even a reasonable comparison.
You looked into it. Give us some numbers.
The market in 1840 consisted of about 300. The U.S. or the New York Stock Exchange consisted of about 300 companies. So it was bigger than I thought before I did the research, but the vast majority of those companies were upstart railroads and bank stocks. There really wasn't anything else. There was, by 1844, there was a telegraph company.
Yeah. And
there were some canal companies.
Canals and maybe some horse whip companies or something.
No, buggy whips. They never, ever made it public. They just didn't go. They were a little local for most businesses.
Yeah.
Didn't need funding on a national level because most businesses in the 19th century, the 18th century, they were local businesses based locally. They did not do business nationally across the country, and that was very, very rare. And speaking of doing business nationally across the country, I did check on Norway for you.
Thank you, which I really appreciate, because I was going to ask you about April 1842. So go ahead.
The number one company in Norway is currently Equinor.
Equinor, yeah.
Of course, you've heard of them.
Yeah,
nope,
sure.
Don't know them.
Nope,
DNB is number two.
No, sorry.
Kongsberg Gruppen. How about Telenor?
Nope. Keep going.
Aker BP.
I don't think it's getting better.
I know you're going to know the next one. You got to know the next one.
Yeah, I hope so.
Norsk Hydro. You've heard of it.
Norsk. Yeah.
Norsk Hydro.
Yeah, okay, sure.
And the biggest of them has get this is how small a market Norway is. How many billion is our largest company, or trillion, I should say?
A couple of trillion.
Yeah,
right?
like 4 trillion. The biggest company in Norway is $65 billion market cap.
65 bill? That's it?
Market cap.
Tiny.
Anyway, what happened in 1842?
Well, that was the end of the 10-year period that really went down. You can remember that one. I mean, certainly that's one well-known in history, right?
Was there a crash in 1842?
No, but that was an end of a 10-year period. And I'd love to know how many of those companies still exist today. Let me guess. None.
None?
Yeah, they're not around anymore. So, okay.
I don't think, honestly, I think it was none.
He also goes in to discuss that he thinks he's trying to tell people they should own more bonds. He said, no, bonds can have bad performance. The decades from 1946 to 1981. He does not mention, frankly, the last 5 years for bonds, which have not been very pleasant either. And then he also said another misconception people got out of his paper was that you should not own international stocks. He says, I would expect that sometimes international stocks will outperform U.S. stocks. And sometimes, guess what? U.S. stocks will outperform international stocks. It just happens.
It goes
we've
that way.
seen it. It goes that way.
The reason 1842 was bad was because of the horrible panic of 1837.
Oh, yeah.
This is when Andrew Jackson messed with the banking system, shut down the second Bank of the United States, second National Bank of the United States, and over 40%, get this, in the 1840s, over 40%, or the 1830s, over 40% of banks failed, mass unemployment, wage deflation, price deflation. The country was in a full-fledged depression after 1837. So that's why stocks didn't do so well.
And then you knew, of course, with the Civil War coming up in 1860, you didn't want to be investing then.
And everybody knew that was coming.
Oh, they didn't? Oh, okay. Well, I'm just saying, you knew that was coming up in the fall of 1860. Anyway, so all kidding aside, I mean, my takeaways from this still would be, even if he was right, even if these numbers are right, if there's 10 and sometimes 20-year periods, what would be the alternative?
Oh,
what would you take your money and where would you put it? Right.
It's funny, in the Dimensional Funds interview, that was one of the answers that David Booth gave. He said, if you think the market's going to go down, where are you going to put it?
Yeah. I mean,
is he going to put it in bonds? You don't like bonds.
And he points out that his paper that, stocks have outproduced bonds by somewhere around 400 basis points annually, going way back, right? I mean, that's kind of the thing that Booth would talk, 10% in stocks, about 5% in bonds, cash less, et cetera, et cetera. So that would be one. Number two is, if you don't believe in stocks, I think have a negative view of the future, because investing in stocks is believing in optimism, right? That things will grow, companies will get more efficient, those things. Which is fine. I mean, I'm not going to run around and put the rose-colored glasses on. If you are that pessimistic, if you believe that the world is coming to an end, there is one thing you need to own a lot of, and I hate to say this. I asked David about crypto too. He laughed. What did he say?
He laughed. He just laughed. I said, "Come on, I need somebody else to get in trouble with me. Come on." He just laughed.
Get in the playpen, have some fun.
No, dude. Guns, ammunition, and ammunition.
And canned foods.
No. Guns and ammunition.
Oh, because you can go to your neighbor and steal his canned food. I can go steal
your canned food.
That's fair enough. Yeah. I have some tomato paste that you're going to love from about 1995.
Yeah, there's nothing like canned tomato paste.
Add a little water, you'll be in good shape. So, I mean, okay, so those two things. And then, again, when you're looking at any investment, anything like that, other than history, what should you consider? I mean, there is nothing else to get right. I mean, as Booth said, looking back 100 years where we have pretty good data, what else could you consider about making a decision about the future?
Psychic ability.
Okay, well, if you've got that person, then go to them immediately.
Actually, he had another fascinating number two. People have already heard this. No, they haven't heard it yet. I don't know if they've heard it or not. He said, how the Dimensional has beaten the indexes overall with their funds.
Yeah.
And then the truly active funds, the market timing funds, people try to predict the future, the psychics, in other words, dramatically underperformed. So there's this.
Wait, they underperform? They can't see the future?
I can't see the future.
Wow.
So you're in trouble if you think it's future seeing.
Yeah, I think that's good. So while I appreciate this, because it's always good to be questioned about things, that's good. I mean, like competition, it's a good thing. I would still be an investor in equities because I don't know what else to do with the money. And I believe that capitalism will provide additional money, make money on my money in ways that I could not do it on my own. I'll put it that way. Or I'd have to start another business, and I'm just not really interested in doing that. You're not interested in doing that either. We've talked about
I'm absolutely not interested in doing that. No.
We've done it.
Not.
Yeah.
I'll answer people's questions, though, if you have any. Do you have any?
Yeah. Oh, yeah.
Right.
Yeah. This comes from DM in, I think it's Milton, Washington. How to determine what to look for if an investment in this type of company meant for investors with minimal initial investment, $100,000, and may need access to cash in emergency. The investment is the Blue Owl Credit Income Corp, OCIC. Now, I'm just betting. I think this is some sort of private credit.
I don't know. Hold on.
OCIC. I had not heard of it privately.
It doesn't sound. If it has a symbol, OCIC.
Yeah.
What's the name of it? Owl?
Blue Owl, OWE, he has Credit Income Corp.
Oh, Blue O.
Blue Owl, ow, whatever, however you want to say it. It's going to be ow at the end, I think. Is what
I think it's owl. I think it must be owl. Blue Owl. Give me the rest of the name.
Credit Income Corp. You couldn't find OCIC?
No. No symbol. No symbol. Blue Owl Credit Income Corp is a private credit strategy.
I was right there. Sure.
Fund.
Yeah.
That seeks. They don't promise anything. They seek to generate attractive,
by the way,
risk-adjusted returns.
Okay,
they seek to, but they don't know that they will. I mean, they can't guarantee it. I'm sure they take big risk.
He wants it for the income and may need access to it for cash in an emergency.
Okay, well, the income is pretty hefty.
I imagine so.
About 10.5% a year. The portfolio is, let's see, it is first liens on property generally, but if it's paying that much, that tells you the kind of first liens they are. They're people who are really hungry for money. They can't get a traditional lower interest rate loan.
Hard money, we could call it?
Yeah. Oh, they won't let me download a prospectus unless I give them information. OCIC, yeah.
Can go, according to him, you can go to OCIC.com to read.
Yeah, that's where I went.
See the overview presentation.
Yeah, I don't want this stupid overview presentation because
then they're going to be calling you every day to put your money in.
Right, and I don't believe most of what these people pay.
All right, but let's just be honest about private credit. Can we? Even setting that as
dangerous.
Liquidity. So if you needed this for an emergency fund, there's no way I would do that because they may have a liquidation problem at some point, right?
Could.
Yeah. Number two, how transparent are they about what they actually own?
Well, I've got their top 10 holdings.
Okay. Well, that's helpful.
I've never heard of any of these companies, but
that's not so helpful.
I'm just trying to find their fees and expenses. And boy, are they hiding. They are really, really hiding them.
Now, 10% is not a guaranteed 10, correct?
No. That is
income
their
currently being produced. Okay.
Yeah. That is what they're paying. They're not guaranteeing anything. It's a high risk investment. It says in their distributions are not guaranteed. It says right here in their disclosures.
So back to your question, DM, how to determine if this is meant for investors, mid to low risk takers, income with need access to cash. No, this is not something I would do. You've already heard us explain on the program why we're not fans of private credit as an investment anyway.
Okay, there is a sales load of 3.5%.
So that's good. So the guy who just put you in the 100,000, he made a nice $3,500 payday.
Yep. But boy, finding their fees, maybe it's in this thing. I just find it really fascinating that it's hard to find the fees, and they won't let me look at a single thing without giving them my email address.
Don't give mine just to get it either.
Let me give them yours. That's a good idea.
All right, should we move on? Because this is not the kind of thing I'd recommend. No, or anybody for that matter. I don't care what your risk level is. Hannah writes us from Redmond, Washington. Hi, Don and Tom. I'm a longtime listener. I have a question about lifetime fixed income annuities and guaranteed rate fixed term annuity. I had a meeting with a Fidelity financial advisor to discuss the portfolio of my accounts. He suggested I move my assets to a cash refund lifetime fixed monthly income annuity. That's a lot of words. Starting with $1 million. When I pointed out I didn't want to give up control of my asset for the rest of my life, he said, whoa, wait a minute. What about the guaranteed rate fixed term annuity? Said that's the same as a CD, but a higher interest rate and tax deferred until I withdraw. I want to hear your advice and opinion on these two annuities before I make any decision. Can you please explain how these two kinds of annuities work and what kind of personal situation should consider these type of annuities?
I'm going to scold Fidelity again. Apparently, commissions are now driving their recommendations. These are
without a doubt.
These are did she give us the name of the product?
Well, kind of. The first one, remember, was the
I don't. That's why I asked.
Cash refund lifetime fixed monthly income annuity. It's a lot of words.
Oh man.
Cash refund lifetime fixed monthly income annuity. I don't understand the cash refund part, what that means.
I don't. It means there's some little rider in there that sucks away more of your, without knowing the name, I don't know whose that annuity is, but my guess is it has a hefty commission.
Yep.
They're going to pay a little bit more than a CD because the insurance company takes risk with your money to make more money than they would make on a CD. So they're going to give you a bigger chunk of that to attract you into it. Here's the problem with annuities. This is what you're going to hate about it. Read the prospectus. Read the disclosure documents.
Don't do it right before you're going to bed because you won't last. Sorry.
Read the disclosure documents. If you find it's like hundreds of pages long, there's a reason for that.
Because they're putting stuff in there you might not want. What about the guaranteed rate fixed term annuity?
Well, they're two different things. There's one that's an income annuity, and the other one is just a fixed rate annuity, a fixed annuity, which is going to pay you a certain rate over and above whatever
better
CDs
than
are paying.
CDs, he says,
Better than CDs, sure, better than CDs. But this business of, I hate that insurance companies are able to get away with saying our investments are no risk, just like a bank CD. That is just not true. A bank CD is backed by the full faith and credit of the U.S. government through the Federal Deposit Insurance Corporation. An annuity is backed by the full faith and credit of the company that issues the annuity.
Yeah, but Hannah points out something here that I think everyone should consider when buying an annuity. Why do I want to give up control of the asset for the rest of my life?
Well, you don't in the fixed interest annuity, the fixed annuity. That is not a life. That's not an immediate annuity. That's just an annuity where you make an income, a certain income, and you can get at your money.
But what about the second one?
No, the second one is
guaranteed rate fixed term annuity.
Yeah, that's the one you can get out of.
The cash refund lifetime fixed monthly income annuity.
I don't know. That sounds like it's an immediate annuity. So they're going to be paying you. They take your $100,000 or your $1 million.
She says.
They take your $1 million. They keep it. They pay you an income for the rest of your life.
But you're giving up the money.
But you're giving up the money. The other one, the $1 million goes in. They accrue income to your account that is deferred until you take it out. So it's a deferred means of generating an income, but you will eventually pay taxes on it.
Okay, but I always want to go back, Hannah, to say, why do you need an annuity?
To get a higher income, and that's what the sales pitch is. That's what the sales pitch is.
So in other words, it's a higher, and I'm using air quotes here, guaranteed annuity. People feel like, well, that's guaranteed.
Right.
Well, it's, as you said, guaranteed as long as the insurance company can pay.
Mm-hmm.
But you're giving up, there's all those trade-offs, the commission, the lack of liquidity. There's other stuff there that the trade-offs from doing that. So I would first ask myself that question. I would look at my overall retirement plan and say, do I need a set amount of income from something?
And I would also do this. I would say to the guy at Fidelity, so how much commission do you get off of this?
What do you think he gets on one of those on $1 million? That's a pretty substantial amount.
4 to 5% probably.
Wow. That's
4 to 5.
Talking real money.
Yeah, and speaking of talking real money, I finally was able to look up and find Blue Owl or OCIC's fees.
Oh, yes. Okay.
Okay.
Am I going to be happy or am I going to be sad here?
Oh, you're going to be fascinated. You're going to be
fascinated.
You're going to be just amazing.
Okay.
They get what is called an incentive fee of 12.5%.
Excuse me?
Of all the income above 5%. They get 12.5% of realized capital gains, should there be any. The total annual expenses, including what they pay in interest, because now it's a leveraged product. So they're lending money to people and they're borrowing money to lend money. So just more risk added in. The expenses, including interest, are 10% per year.
Yeah.
Without interest, it's 2.4% per year.
There you go.
If they can pay themselves a percentage of the interest, the 12.5% of the interest, and they can pay themselves 2.39%, and they can pay you 10.5%.
Figure it out.
What kind of loans are they making?
Some pretty lucrative stuff that may or may not pay you back.
Which means risk. If I was a business and I was going to go out and borrow money, with all of those things added in, you're looking at, I would be paying 13 to 14% to the lender. If I was a big business with, and I was in good shape, and I would not pay 13 or 14% when I could borrow money at 7 or 8%.
Yeah. This is off the charts with risk then, and not to mention expense. All right,
we have two of them that are. This is all of these are sales driven. You are being sold these products. You never want to be sold products. You want to go seek them out on your own.
I think that's exactly right. You mentioned Talking Real Money, and we're going to be on the road soon. No,
we're not. I'm going to stay right here in my studio.
I'm going to be on the road in Phoenix on Monday, April 14th. Still got one slot left to meet. Love to see you and talk about your situation, review your portfolio, do all that stuff. Guess what? It's free. Does not include golf or drinks on the veranda. But
is this Mr. or Mrs. Slot you're meeting?
I'd love to meet both of you.
It's Edna Slot and her husband Frank.
So
if your name's Slot, there'll be another Slot.
Exactly. I'm always
we'll slot you in.
Monday, the 14th of April, coming up fast. Still one appointment left, if you will, Mr. Appointment, if you can.
Mr. Schlott. Actually, it's pronounced Schlott, not Slot. Schlott.
You're really doing me a lot of favors here.
I try to.
So you simply go to talkingrealmoney.com, click on Meet an Advisor, and then when you fill out the forms, they want to meet with Tom in Arizona. So, and get that last position, time, appointment filled. So, and by the way, our
members
advisors
of the Schlott family are invited. You'll get in first.
Are always here to help you. So, and we want to do that. Take advantage of it.
What nice restaurant are you taking all these people out to?
Oh, I'm not taking them to a restaurant. I'm sorry. I go into a Regis, you got to bring your own sandwich.
Dang.
not exactly.
So this is not a luxurious steak dinner like those other firms?
I know.
What is wrong with us?
I'm not a very good person. So take advantage of that. Get some help. I tell you one thing.
Yes, please take advantage of Tom.
I tell you one thing right now is coming. We are not predictors, but we did tell you to be diversified. Somebody just wrote us a nice note and said, thank you for telling me to be in international stocks. Like we did it recently.
We've been telling you to do that all along.
30 plus years. But it's been better this year. You need to know what's in your portfolio every single day so that it's properly diversified. It's taking the amount of risk you want to take, and you know how much you're paying others. So we do that absolutely 110% free of charge with no cost or obligation, no high pressure sales pitch.
Be careful of what you say. When you say 110% free of charge, that means you owe them money.
Oh, dang. Well, there's the steak dinner.
Yeah.
So that's for that. Anyway, want that kind of help? Again, go to talkingrealmoney.com, click on Meet an Advisor. Just trying to help.
There you go. Yeah. And then every single day, you just go to your little friendly podcast service and you listen to us because we are here almost every day talking real money.
The opinions and views expressed on this podcast were current on the date recorded. Opinions, estimates, forecasts, and statements of financial market trends that are based on current market conditions constitute our judgment and are subject to change without notice, including any forward-looking estimates or statements which are based on certain expectations and assumptions. Although information and opinions given have been obtained from or based on sources believed to be reliable, no warranty or representation is made as to their correctness, completeness, or accuracy. Information presented on the podcast is not personalized investment advice from Appella Wealth. The views and strategies described may not be suitable for everyone. This podcast does not identify all the risks, direct or indirect, or other considerations which might be material to you when entering any financial transaction. Past performance does not guarantee future results, and profitable results cannot be guaranteed. We hope you realize that the information provided on Talking Real Money is for informational, educational, and hopefully enjoyable purposes only. The podcast is not trying to get you to buy or sell any financial products or securities. Instead, the program is provided as a public service by Appella Wealth, a fee-only registered investment advisor. Please see Apella Wealth's ADV Part 2A on our website for information regarding Apella's fees and services. Apella Capital, LLC, DBA Apella Wealth, is an investment advisory firm registered with the Securities and Exchange Commission. The firm only transacts business in the states where it is properly registered or excluded or exempt from registration requirements. Registration with the SEC or any state securities authority does not imply a certain level of skill or training. Apella does not provide tax or legal advice, and nothing either stated or implied here should be inferred as providing such advice. Thanks for listening, and please visit TalkingRealMoney.com for more information and important disclosure related to performance of any specific index or fund quoted in this podcast. And the lawyers get richer.